Jose, do you go by Pepe? Okay, that's what I've seen on Blackboard. Okay, Pepe is going to be our person to try. Okay. So tell me what you think about this question. What do you think the answer is, and why is that answer is correct? That's more important. Okay, let's see. And when I tell you guys to grade, grade, you guys are going to use your P-Rator link and give him a rating. Okay. Why do you think, why is that answer correct? Ex Explain to me. And a little bit louder, please. Okay. Mhm. Okay. Tell us what a paid in surplus is if you know. Tell us what a paid in surplus is if you know. Okay. Since today's warm up, I'm not going to worry about it too much. Uh, when companies issue a stock, they give that a nominal value. Let's say we have 400 million shares, and we're going to call them worth $1 nominally. Common stock would be $400 million. But when you sell that to public, they pay more than $1. They said, let's say they pay $10. Then the additional $99 times 400 million, or I'm sorry, $9 times 400 million, which is 3.6 billion, is paid in surplus. Okay, that's the difference between common stock and paid in surplus. So why is not bond payable part of? Okay, now I know it is not a discussion. Okay, it's okay to say I don't know. That's fine. Okay, uh, you can rate his. Let's see his discussion. I mean, just to give you an idea, I'm gonna rate it as good. Okay, and once you rate it, just hit submit another response. It'll get you ready for the next round. Okay. I mean, obviously, if you rate yourself and you rate yourself too much, I'm gonna get it from you. No, no, no. If you are the one being rated, don't do the rating, and you are required to do the rating. Again, if you're rating a group, nobody in the group that's providing the discussion are not supposed to give the rating. If you do, I'm gonna ignore that anyway. But you don't have to do it. Uh, let's pick another victim. Begley. I have no input into this. In fact, even the number of times I do randomize is random. It's somewhere between 500 and 553. So it's double randomness. So we're going to ask Begley the next question. Again, you enter your own name, not the person you're evaluating. Okay? Because I get the person who's being evaluated from my own input. I mean, I haven't implemented this part yet. For now, I'm using a form, but I was supposed to do that this weekend, but I was sick. But I'm gonna do it right on my sheet, and you guys will see what I'm giving. All right, let's ask Begley something from income statement. What do you think about that? Again, a little bit loud so that people can hear you. And why do you think that is? If I ask you this in a kind of multiple choice stuff, not only you have to tell me why is that the right answer, but why do you think the others are not? Why doesn't it? The fact that you know doesn't mean anything. Convince other people that what you know is indeed correct. For example, why doesn't it increase net income? Net income. Well, that's balance sheet. Depreciation is an expense, okay, for accounting. So when an expense goes up, what happens to your income? Goes down. Okay. How about, I mean, we know that it is a non-cash expense uh, because when you charge depreciation, nothing comes out of anywhere. It's an on-paper expense. Economically speaking, there is a logic to it. You basically, use up. Example, you buy a car, new car, and 6 months later you go back and you want to trade that in. Even without the car dealers taking advantage of you, you're not going to be able to get the same value. Why? Because your car depreciated. How much it depreciated, it depends on the market. For example, a year and a half ago, used cars were at a premium. Uh, I had a 2008, no, 2018, uh, somewhat big car owned by Chevy. When it was new, it was about 50 grand. I bought it used around 27. About 2 years after I bought, I was able to trade that at 26 and a half at 97,000 miles. When I bought it, it had only 70. Because of COVID issues, there were supply chain constraints. And if you wanted a new car right now, you had to wait. But used cars were available now. So they had a premium. So what market charges as depreciation changes depending upon market conditions. You know, a Japanese car in the market at least tend to depreciate a little bit less compared to American cars. You can take the same $30,000 car, one from an American manufacturer like Chevy, the other from Subaru, and come back 6 months later. I would be extremely surprised if your trading value for Subaru is below 28, but the Chevy is going to be below at a maximum 24. Market perceives the Japanese cars a lot more durable. Whether or not that's correct is besides the point. That's what the market charges. But the depreciation that we use for accounting, it depends on formulas. Okay, we'll talk more about them in chapter 8 when we're thinking about project evaluation, how assets are depreciated. There are a variety of methods. One of them is called straight line depreciation. If it has 10-year tax life, every year you write off 10% of that as depreciation expense. There are also something called accelerated depreciation, known as MAKERS, Modified Accelerated Cost Recovery System. You actually charge off a lot more in the first 2 years than the rest. IRS assigns the tax life to these things. For example, a computer with a tax life of 3 years On the other hand, an equipment will have something like 7 years. Machinery in general may have 10 years, 15 years. I have no idea. I'm not an accountant. IRS tells you exactly what those are. Okay. And based on those, you can do it. You could even do stuff based on depletion. Let's say you own a oil well, and proven reserve is 10 million barrels, and that year you took off 2 million barrels. You extracted. You write off 20%. If you took off only 500,000 barrel, you write off only 5%. This is also used quite a bit for things like trucks. You have a commercial truck you're using. It has a usable life of 100,000 miles, let's say. And that year you drove that truck for 30,000 miles. That year you can write off 30%. If you drove only 5,000, you write only 5%. So, again, this is not accounting costs. We're not going to worry about those. Only in Chapter 8, we're going to worry about straight line versus makers. But even for that, I'll give you guys a template. All you have to do is enter your inputs and get those. Knowing what depreciation is as a number is not that much important. A computer can tell you that. But what is depreciation and what it is used for, that's something different. It reduces your taxes. Yes, it reduces your net income, but it doesn't affect your cash flow. In fact, it affects your cash flow in a positive way. Because if you have $1 million depreciation instead of two, you're going to write off $1 million less, which means you'll pay $1 million more in taxes, or whatever your tax rate is. Let's say 20%. You would pay $200,000 less in taxes if you have $2 million in depreciation versus one. So in that sense, depreciation would increase your cash flow, even though it decreases your net income. Okay. All right. Let's give Begley a good rating as well. I mean, that's what I'm giving. Whatever you're giving is your business.
Question.
Yes, Tom Mix.
So anytime we have these like questions like that, everyone in the class is rating that student.
Yes, everyone other than that student.
Okay.
I mean, that student could also rate himself or herself, but that doesn't mean anything because I'm going to catch that in the Excel and basically ignore that. All right, let's pick one more person. Then Ethan Gross.